Let's talk to Marc Ostwald. He is from ADMISI. Very good morning to you, Mark.
Good morning.
Right, 5 very tricky charts coming up.
Yes, I think it's, at the end of the day, everything is about flows in financial markets. We can look at the macro, we can look at the politics, but at the end of the day, it's flows that matter. And obviously the biggest flows that have been influencing financial markets for the past 10 years have been those from the central banks.
Yep.
So just a reminder here of where we are. Where the big arrow is, basically we're now at a stage where central banks are draining liquidity from financial markets, and that's fairly big headwind. The one thing which is actually missing from this chart, and I haven't had time to sort of put it in, is the fact, and it's probably the most under-discussed thing I can possibly think of. I've not heard anyone mention it today, till today, and that is the Chinese central bank has actually drained 1.25 trillion yuan from its financial markets. Now, if you think of it from that aspect,
Yep.
the fact that the Chinese stock market has been, well, some people would say collapsing, it's not really a great surprise. And it's also a good reminder of why they're now desperately trying to row backwards and inject some liquidity in there, which is obviously quite a positive thing for financial markets, and it should at least work as a counteraction, at least domestically for China, to the impact of what's going on elsewhere. But the Fed is draining money from the market, the ECB is no longer injecting, and interestingly, on the next slide, we've got to this ridiculous point in the world that the Bank of Japan's balance sheet is now bigger than the nominal GDP of Japan. Should we be surprised then that all the noises
Surprised or worried?
Well, we should be worried,
Yep.
given that the boost to the Japanese economy from all this injection has hardly been spectacular. We had the Japanese GDP data, albeit one would say impacted very heavily by earthquakes and natural disasters, but it was negative. And yet they've been injecting all this money for all that time. And even in the second quarter of this year, when the economy managed to grow sort of in the 1.5–2% area, it's hardly a great return for all that excess liquidity. But it's also a reminder that they are going to start to row back, because it is basically an unsustainable situation that they would have a balance sheet that big. So what are we actually seeing as a result of all this draining of liquidity? Well, let's go through a couple of other charts. First of all, this is interesting because what we're seeing, this isn't actually the Lipper fund flow data, but it's a good proxy for it. This is the flow of money into US mutual funds, particularly fixed income funds. And what we're actually seeing in October, there was basically $52.5 billion taken out of US fixed income taxable bond funds.
Yep.
Most recent week, that trend is still continuing, another drain of 1.2 billion funds. And it's starting to have an impact on these funds. For a long, long time, money was always being allocated to bond funds. Now things are starting to change because that central bank liquidity is being withdrawn. So how is it going to change? Well, one of my favorite topics has been, for most of the year, looking at what is the straw that breaks the camel's back of risk-taking in markets. So if we have a look at the next chart, this is the average spread of investment-grade bonds in the US, denominated in US dollars, relative to US treasuries. It's been gently widening at 114 average spread. That's 114 basis points. I wouldn't exactly call it wide, but what's very clear to see is the tide is distinctly going out, particularly in Q4, and it's going out quite quickly. More importantly, if we go to the next chart, which is one of the ones I think I've shown on this program many a time, and I pointed out that when we're having all the emerging market woes, obviously the emerging market bond spread started to widen very substantially. That's that yellow line. But what has normally been very well correlated, which is US dollar high yield bonds, because they're considered to be roughly equitable in terms of risk, defied everything and actually tightened to its lowest levels since the financial crisis. Well, here we go. We've now gravitated to exactly the same point. Both are on an average spread of 404 basis points. The outflows from high yield bonds have been actually very, very severe. Eminently, one would have to add, because I think it's roughly 40% of all high yield bonds are issued by energy companies. The fact that we've had this major sell-off in oil would obviously not have helped the prices of the bonds of a lot of those. But it really does tell us now that we're into a much more volatile environment. We do need to take far more notice of the central bank fund flows, and it's going to be a lot choppier waters for people to navigate, and we do need bigger risk premiums in a lot of risk assets. I'm not necessarily saying we're going to have a crash bang wallop, but what I am saying is we do need to factor in much higher risk premiums, which will be good for investors to a certain extent, of course, unless they were long from the very tightest levels, in which case they're going to be under some pressure. But for others who've been cautious, allocated money to the short end, defensively, waiting for the opportunity when spreads widen, this starts to look like quite a good opportunity.
Mark, on that note, thank you very much indeed.